Good morning. Happy Monday, and welcome to Island Park Private Wealth's Monday morning market recap. As normal, we'll give you a little recap of the market action last week and give you our key takeaways from all that action. So let's jump right into it. Markets leaned risk on this week as the Fed delivered its third consecutive rate cut and investors doubled down on the soft landing narrative. Stock wavered early but rallied after Wednesday's Fed decision, with the S&P 500 and the Dow moving toward all-time highs. The Russell 2000 set record highs on consecutive days, and the equal weight S&P 500 outperformed the broader index as leadership shifted from mega cap growth to small caps and cyclicals. The Nasdaq and the large cap growth stocks finished the week mostly unchanged, and defensive sectors lagged. In the credit market, bonds ended the week with modest losses as Treasury yields edged higher in anticipation of the Fed pausing its rate-cutting cycle. Oil held near a four-year low, reinforcing the disinflationary tailwind, while gold hovered near record levels and Bitcoin remained volatile. So what are Island Park Private Wealth's key takeaway from that message? The first takeaway, well, labor data continues to show a job market that is solid but cooling. Job growth and hiring are slowing. Wage inflation is easing, but there's no sign of broad-based layoffs. With the shutdown delaying the official jobs report, the Fed and the markets are leaning on proxies like ADP, payroll data, job openings, and jobless claims. So the soft landing narrative remains intact, but the lack of timely data is keeping macro uncertainty and event risk elevated. Point number two, recent inflation data reinforces the idea of a slow disinflation process. Inflation has fallen from post-pandemic highs, but it remains above the Fed's 2% target. Surveys highlight persistent price pressure from tariffs and supply chain shifts. And while oil trades near a four-year low, its disinflationary pulse could reverse with elevated geopolitical tensions. So the disinflation progress continues, and it gives the Fed cover to cut interest rates, but tariff uncertainty and simmering geopolitical tensions mean the disinflation story is fragile. Point number three, the Fed delivered a widely expected 25 basis point interest rate cut this week, its third in a row. However, it did so in a way that framed the move as fine-tuning rather than a start of a prolonged cutting cycle. The decision was unusually divided with a 9-3 vote, highlighting significant internal dissent, and the Fed forecasted only one rate cut in 2026. Chairman Powell's commentary highlighted the uncertain outlook, reinforcing or referencing both the soft labor market and mixed inflation data. So the Fed did stop short of calling for a rate hike, but also didn't endorse the market's forecast for two cuts in 2026. Fed officials believe they're in the right neighborhood and now want to wait to see what happens. Point number four, markets treated the decision for an interest rate cut as a green light for risk, with equities rallying toward record highs. The more notable story was the broadening in market leadership from mega cap growth towards small caps and cyclical sectors. Treasury yields declined, led by the front end, as Chairman Powell pushed back against a potential rate hike, and credit spreads remained tight. Gold remained near its all-time high, signaling concern about the combination of a policy mistake, inflation, and geopolitical tensions. And Bitcoin stabilized but remained volatile. Market pricing and investor positioning reflect high confidence in the soft landing. Now, point number five, JP Morgan described the U.S. consumer as a bit more fragile, noting households are feeling the squeeze from higher prices and fading excess savings, even though credit metrics remain generally healthy. The message was less about an imminent downturn and more about a consumer whose cushion is thinner than a year or two ago. Now, the consumer is the main engine of U.S. growth, accounting for nearly 70% of economic activity. So a slowdown in consumer spending could translate into slower economic growth. And last point is this week's inflation and jobs report take on an outsized importance with the Fed on pause and the economic data backlog from the shutdown still clearing. The reports will help answer two key questions. Is the labor market simply cooling or starting to weaken more significantly? And two, is inflation still progressing towards the Fed's 2% target or stalling in the 3% range? Markets have traded this story for a few weeks. Now they get fresh data to test it against. And that's our Monday morning market recap. But I want to wish those who celebrate a happy Hanukkah. And we look forward to seeing you all next week. And of course, if you like our messaging, please hit the subscribe button and share it with your friends and families. Thank you. Have a great week.